What you see there are the first 7 months of the year in the S&P 500, sorry, the MSCI World Index price returns, and the numbers 1 to 30 are from JPMorgan Private Bank. They sent me this across. I think it's fascinating because what they list are 30 events which caused the markets to move. Now, if you predicted any of those, congratulations, you should probably fill in the lottery as well. Okay? Or think about a padded sell because you're self-delusional. It gives probably the best possible reason why you should not be reading narratives and stories and gambling on market outcomes and trying to bet on the next direction of the market in the near term. And you're far better off doing what we do in the Great Investments Program, is picking good quality companies and holding them. Unless, of course, you do really want a short-term time period, and we won't go shorter than 12 months anyway, and you want really tight controls like a 25% stop loss, but the risk of that is, as this shows, shorter the duration, smaller the drawdown that you're willing to accept, the higher the risk, of course. So if you elongate the time frame, continue with quality companies, then you should do better. Okay? But I think this actually depicts it. And by the way, in case you're wondering what some of those numbers are, Israel-Hamas ceasefire reached, that's number one. Trump sworn in. Chinese startup DeepSeek rattles AI confidence. Trump slaps 25% tariffs on Canada and Mexico, 10% on China. I'll go through a few others. Trump sets 4th March date for postponed Canada and Mexico tariffs. Google to acquire cybersecurity firm Wiz in largest ever deal. S&P 500 plunges 6%, its worst day since the pandemic. That's 15. That's 0.15. Now it's at an all-time high. So again, trying to gamble. Did you see the all-time high and the plunge? Well, you'd have to be bipolar to have seen both, necessarily bipolar, because what you would have saying is, I can see the worst scenario since the pandemic, but at the same time, I can also see an all-time high. You might have called one of them all right, but actually, if you didn't call the other, then that's pretty useless anyway. We do one of two things, either a model portfolio which goes through all this noise and says we're going to hold it probably for 3 years, good quality companies, undervalued, high growth, dividend yielding, ignoring all of the short-term moves, or if you want to be more in control, 12-month period holds with 25% stop loss, more likely to be stopped out and only held to 12 months before reevaluating, but that's because you want to be more on top of it all with all its inherent risks of doing that. So when we go into cash, when we did go into cash, it was because we were happy to pay the insurance premium that you have to pay, that in case the house burns down, at least we're in cash. And if the house doesn't burn down, guess what? We lost our insurance premium by buying back stocks a little bit higher than